Well, hello, it's Bob. I'm back again with another video. In today's video, somebody just asked me, hey, this one company has a 28% dividend yield. Is it a dividend trap or is it worth looking into? Well, today we're gonna do a deep dive on this company, and if you have other suggestions for future stock picks, drop them down in the comments below. We're gonna talk today about SBLK, otherwise known as Starbulk Carriers Corporation. Let's talk about what that company is, and then we're gonna look under the hood and see if this 28% dividend is worth getting excited about or running away from. Starbulk, what they are, is a shipping company engaging in the ocean transportation of dry bulk cargoes worldwide. Now, if we think about that for a second, anything that happened when it came down to transportation of goods and services, especially in the last year with demand so high and the ability to produce a lot of supply for all that demand, well, yeah, the carrier corporations are going to get a lot of money thrown at them because people are kind of excited about the fact that, hey, the faster you can get my stuff to land, the more excited I'm going to be. So I could see this seeing a very successful year and a half or 2 years ahead, but will it be sustained? That's something we got to keep our eye on. And as of December 31st, 2021, it has a total fleet of 128 vessels with an aggregate capacity of approximately 14.1 million deadweight tons. This company is rather new, incorporated in 2006 and based in Greece. So first thing I like to look at, courtesy of Seeking Alpha, is right here, the dividend summary. Look at that, 28.21% yield, annual payout of $6.60. And that means every quarter they pay a dividend. Their last dividend payout date was on June 16th for a total of $1.65 per share. Pretty darn sexy if you ask me, but let's look under the hood. And in order to look under the hood, we're gonna go do some drawing as we always do, looking at our smart steps for analyzing a stock. Right here it is. We're gonna look at the payout ratio, PE, EPS, revenue, profit, assets, and ownership. Let's get right to it with the payout ratio. Now, in order to look at these and really analyze these the right way, we need to look at what is actually happening on the financials of the particular company. Because again, it's just like a car. You don't wanna go to a car lot and buy this beautiful looking car that you think, man, this thing just looks beautiful, only to realize that when you open up the hood, it has no engine inside of the beautiful, sexy car. That's gonna get you absolutely nowhere very quickly. Over on Seeking Alpha, you go to the dividends tab right over here, and you can look at the dividend scorecard. Now, the first thing that catches my attention is the consistency at a D+. That is telling me that they have not been consistent in their dividend. But if you look back over time, they've actually adjusted their dividend quite frequently. It almost appears as though when things are looking good for this particular carrier corporation, they're paying you money. They're saying, yeah, everything's great. But as soon as things turn, they're like, yeah, we're gonna lower the dividend payout and we're not gonna be consistent. We wanna see consistency in the overall payout of the dividend, whether it's a quarterly, monthly, or yearly basis. Overall, the payout ratio that we look at is at a 68.88%. So what you would look at here where it says payout ratio is you don't want it to look like it's over 100%. If it's over 100%, that means they're taking all of their earnings, all of their potential profit, and paying you dividends. Now, in the case of stocks, which is what we're looking at here, we're not looking at things like REITs and BDCs, we're looking at a stock. So 68% is okay. That's fine. But if it's over 100, it's time to get worried. So we'll go ahead and say that the payout ratio gets a green light. I'm just gonna simply highlight it to make it easy on this video. Isn't that nice? Let's look at the PE ratio. That stands for the price to earnings ratio. What you need to look at here, especially in the summary tab of Seeking Alpha, if that's the website you decide to use, you want something that's relatively low. I like to look for opportunities under 15 on the PE ratio, and look at that. The forward PE ratio right there sitting at a 3.44. You know what that means. It's not hard to say that is definitely a green light because it is well below that 15 aggregate number that we look at for the PE ratio. By the way, what you're looking at now is Seeking Alpha Premium. I've decided to upgrade because it gives me so much more data. If you're interested in Seeking Alpha, the premium version, I'll include a link down in the description below. Go check it out and get started today so you can follow along with me and do your own research and your own analysis, because again, none of this on these videos are financial advice. Just giving you the tools and the education so you can become a better investor yourself. Next thing we want to look at is earnings per share versus what the analyst said they were going to do. And right here is where we look at it. Right down on the bottom, halfway down on the summary sheet, you can see for the quarters, the blue line represents the actual, what the company did, and the black line represents the estimate. And it looks pretty good. Let's actually go, I'm gonna click here and go to annual just to see how this looks. So as you can see, 2018 looked pretty good. They beat their estimate. Blue line is above the black line, right? Same thing in 2019. 2020 looked okay. They did beat it, but obviously it dropped as a result of the pandemic. That makes sense. And then completely resurged in 2021. So you can see the actual is above the estimate. Now, I will give this a green light, but I would say that it's getting close to a yellow light. And I'll tell you why. It's a yellow light until I feel good about this right here, because I want to see 2022 beat that high estimate. As you can see, right here in 2022, they're estimating the most earnings per share as it has been throughout this entire period. This is the highest it's been. Are they going to be able to meet or exceed that estimate? And if not, I'd be a little bit worried and I'd keep a closer eye on that. And that's why, as a stock investor, when you buy any type of share of stock, remember that you become part owner of that company. In order to become part owner of that company, you got to keep your eye on your company by looking at the financials and the results. Whether it's Seeking Alpha or any other thing like finance.yahoo.com, it doesn't matter what it is. Find what works best for you and stay consistent with keeping your eye on the game. Let's go to revenue. What we want to see on revenue is we want to see revenue continue to grow. All you do at the top here, go to financials. And after you click on the financials tab, it's right here on the income statement. We can see all the way back to 2012. Let's look at right now, just right here. Well, actually, no, I'm going to look at the total revenues right here. And these are in millions. So you have 86 million in 2012, all the way up to right here. Look at that. $1.4 billion in in all of 2021. And that's a big increase from 693 million in December 2020, 821, 651. We are seeing an upward trend despite the pandemic and the issues of the shutdown. This looks pretty good. And their TTM is looking at a 1.5. They're still holding strong. Guess what? This is also getting a green light. Now, here we are about halfway through, and we're seeing a bunch of green lights, and that dividend looks pretty darn sweet. So if you're an income investor, could this be an opportunity, with the warning that, of course, none of this is financial advice, but an even bigger warning than that is that you got to make sure that you keep your eye on what happens with the overall climate of the economy related to shipments, because again, they're delivering goods to people. They have vessels. They're out there in the ocean doing stuff. If things slow down as a result of recession, what's it going to do on this particular company? Big warning on that. So let's go to the profit margin. So you can get to the profit margin by clicking on the summary tab on a Seeking Alpha, scroll all the way to the bottom to where it says profitability. Again, if you have the premium version or higher, you'll get the grade scores, but you can see right here at a gross profit margin of 67.77%. We want to see anything over 10% or more. That is absolutely beautiful. Keep your eye on that. For now, we're giving it a green light on profit margin as well. This thing is acing the test. This is very rare. Go look at some of the other videos. Go look at like Disney, Snapchat, things like that. Some of those other stocks, you know, they got some issues, but this one's looking very interesting. Assets versus liability. What you want to make sure is that all of the stuff that they own and deal with, if they have to liquidate, do they still owe money? Do they have enough assets to cover their liabilities, right? That's basically what we're looking for here. By going over to the financials tab and then clicking on the balance sheet, what we're gonna look at is total assets. So right down here at the bottom, you can of course look at total current, but I'm gonna look at total assets for this example. Right here you can see 3754 is their assets. Let's look at their liabilities, AKA their debt. 1674, that's phenomenal. If they liquidate and they sell everything off, right? They satisfy all their debt, all their liability, 1.6. That means they're sitting with a beautiful 3.7 minus 1.6. They're still in the green. Everything is fine. They're not over borrowing. They're not in over their head. That means they get also a green light. Assets versus liability. Let's look at ownership to wrap this one up and see if this ship is going to bring us home with that sexy 20% dividend. So down here at the bottom, we go over here to total shares outstanding, and we want to see this continue to go down. And here we go. Finally, not that I was looking for a villain, but here's our villain, right? Total shares outstanding is not looking good. And here's why. You go from 32 to 43 to 63 to 64 to 93 all the way up to 102. They're adding shares. What you want as an investor is you want more ownership of the company. So let's say, for example, you have one share and I have a total of 10 shares outstanding as a company. That means you own 10% of the company, right? But then all of a sudden I decide to issue more shares. I'm trying to raise capital. So I'm going to take my 10 shares outstanding as a company and double that to 20. Well, 1 divided by 20, right? You still only have that 1 share. Instead of owning 10% of the company, you now only own 5%. You want your ownership to continue to grow. So because they're issuing so many shares, that gets a red light to keep an eye on. So here we have all these green lights and a final red light. That means this is an interesting one to keep your eye on. I'm not telling you to buy, hold, or sell any of these type of things, but that dividend does look pretty darn good. Again, just to recap that at 26%, you're talking about an annual payout ratio of $6.60 or $1.65 potentially per quarter. At least that was what their last dividend was. So that was their declaration date on May 24th. So I would expect to maybe see this sometime in August for their next dividend that comes forward. What do you want to see next? Let me know, and check out this video next, and we'll see you on the next video.